Last night, AI stocks dropped sharply, and the trigger was unexpected. Reports suggest that OpenAI may have missed its revenue targets. That single signal was enough to shake the entire AI ecosystem, from Microsoft to NVIDIA. But here's the real question. Is this the beginning of an AI bubble collapse, or just a healthy correction? In this video, I'll break down what actually happened, how the AI value chain reacts, and more importantly, what this means for your strategy if you're building a business in the AI era. This market move is not just another daily fluctuation. It represents a structural shift in how investors evaluate the AI sector. Over the past 18 months, artificial intelligence has been the dominant narrative driving equity markets, especially in large-cap technology and semiconductor stocks. Companies positioned along the AI value chain have benefited from aggressive capital inflows, with valuations expanding far beyond traditional earnings-based models. However, this growth has been largely expectation-driven. Investors were not pricing current profitability but rather projecting a future where AI would dominate enterprise workflows, consumer platforms, and global productivity systems. In this context, even a minor deviation from expected growth trajectories can trigger a significant market reaction. The recent sell-off highlights a critical turning point. The market is beginning to question whether AI companies can convert technological leadership into sustainable revenue streams. This is not a rejection of AI as a transformative force, but rather a recalibration of how quickly that transformation can be monetized. For practitioners, this distinction is crucial. The narrative is shifting from AI will change everything to who can actually make money from AI. This change fundamentally alters capital allocation, risk tolerance, and strategic positioning. The trigger for this market reaction was a report indicating that OpenAI failed to meet its internal growth and revenue expectations. While the company remains a leader in generative AI, this miss introduces doubt about the speed and scalability of its monetization model. One of the most important signals is the gap between user growth and revenue generation. Despite massive adoption, only a small percentage of users convert into paying customers. This creates a structural imbalance. High infrastructure and compute costs combined with relatively low monetization efficiency. Additionally, the company faces significant financial obligations tied to long-term computing contracts. These commitments require sustained revenue growth to remain economically viable. If revenue growth slows, the burden of these fixed costs becomes increasingly visible, raising concerns among investors and partners. Competition is another factor. The AI landscape is no longer dominated by a single player. Companies like Alphabet and emerging competitors are aggressively targeting enterprise clients, eroding first-mover advantages. The key takeaway is that the issue is not technological capability, but economic sustainability. Markets are reacting to the realization that building AI is expensive, and monetizing it at scale is far more complex than initially assumed. The AI industry operates as a tightly interconnected ecosystem. When a central player experiences a slowdown, the effects propagate across the entire value chain. This is precisely what happened following the OpenAI signal. At the infrastructure level, companies like Microsoft, which provide cloud computing resources, face immediate scrutiny regarding return on investment. Their aggressive capital expenditures are justified only if downstream demand continues to grow at the expected pace. At the hardware level, NVIDIA is particularly sensitive to changes in demand visibility. As the primary supplier of high-performance GPUs, its revenue depends heavily on sustained purchasing from AI developers and cloud providers. Any hesitation in expansion plans can directly impact order volumes. Further downstream, companies such as AMD and manufacturing partners may experience secondary effects, including delayed orders or reduced capacity utilization. This cascading effect illustrates a fundamental principle. In highly integrated systems, the weakest signal at the top can disrupt the entire pipeline. Investors understand this dynamic, which explains the rapid and widespread market reactio. The magnitude of the market reaction can only be understood by examining how AI companies are valued. Unlike traditional industries, where valuation is anchored in current earnings, AI firms are priced based on expected future cash flows over a long horizon. This creates a situation where valuations are extremely sensitive to changes in expectations. When a company is priced for perfection, even a small deviation from projected performance can lead to disproportionate declines in market capitalization. The concept of valuation compression is central here. When investors revise their growth assumptions downward, the multiple applied to future earnings decreases. This results in a sharp decline in stock prices, even if the company's underlying business remains strong. In the case of AI, this sensitivity is amplified by the scale of investment required. High capital expenditure, long payback periods, and uncertain monetization pathways all contribute to elevated risk. Therefore, what appears to be an overreaction is actually a rational adjustment within a highly leveraged expectation framework. The market is not panicking, It is recalibrating the probability distribution of future outcomes. The question of whether AI represents a bubble requires a nuanced approach. Rather than treating the sector as a single entity, it is more accurate to analyze it in layers. At the infrastructure level, demand remains robust. Data centers, GPUs, and cloud capacity are essential components of the digital economy. These assets are supported by long-term structural trends, making them relatively stable. At the application level, however, the situation is more complex. Many AI applications are highly similar, offering marginal differentiation. This leads to intense competition and downward pressure on pricing, reducing profitability. The startup ecosystem presents the highest level of risk. Many companies rely on external funding rather than sustainable revenue. This creates a fragile environment where valuations are disconnected from economic reality. Thus, the AI sector is not uniformly a bubble. Instead, it contains pockets of overvaluation, particularly in areas where competition is high and barriers to entry are low. The most important shift is the transition from growth metrics to profitability metrics. For the past few years, success in the AI sector has been measured by user numbers, model size, and technological breakthroughs. This is now changing. Investors are increasingly focused on whether AI companies can generate consistent and scalable revenue. This involves examining conversion rates, pricing strategies, and cost structures. One critical issue is the cost of computation. AI models require significant processing power, which translates into high operational expenses. If the cost per user exceeds the revenue generated, the business model becomes unsustainable. This dynamic forces companies to rethink their strategies. Instead of maximizing user growth, they must optimize for revenue per user and cost efficiency. The implication is clear. The era of growth at any cost is ending. The market is entering a phase where financial discipline and operational efficiency are paramount. For operators and entrepreneurs, the implications of this shift are significant. The competitive advantage is no longer derived from access to cutting-edge models alone. Instead, it lies in the ability to integrate AI into practical, revenue-generating workflows. This means focusing on applications that deliver immediate economic value. For example, reducing operational costs, improving conversion rates, or automating high-value processes. These use cases provide clear and measurable returns, making them attractive to both customers and investors. Another key factor is execution. As AI tools become more accessible, differentiation moves from technology to implementation. Companies that can deploy AI effectively within specific industries will outperform those that rely solely on innovation. Ultimately, the goal is to build systems that generate cash flow rather than attention. This requires a disciplined approach to product design, pricing, and customer acquisition. Going forward, there are three critical indicators that will determine the direction of the AI market. First, cloud capital expenditure. Companies like Microsoft and Amazon are major investors in AI infrastructure. Changes in their spending patterns will provide early signals of demand trends. Second, hardware demand visibility. The order pipeline of NVIDIA is a key indicator of industry health. Stable or growing orders suggest continued expansion, while declines may indicate a slowdown. Third, monetization metrics. The ability of AI companies to convert users into paying customers is the ultimate test of sustainability. High adoption rates are meaningless without corresponding revenue growth. In summary, the market is not abandoning AI. It is demanding proof that AI can generate real economic value. This shift will define the next phase of the industry.